Under the accrual basis for accounting, income is recognized and recorded when earned, regardless of whether it is received. The concept of earning income implies that goods must be sent to the customers, sold and delivered, or services provided to the customer. If the income earned is received by the end of the accounting period, of course there will not be any problem, but usually that is not the case. Now there are two types of adjustments that we need to make for income. These are income receivables, which is income earned but not received yet, and income received in advance, also known as unearned income. For this part, we will first discuss income receivables. Now, income receivables are amounts of income earned in the current accounting period but will only be received in the subsequent period. The business has already provided the goods and services but has not received the money as yet. Now, income receivables are regarded as income for the current accounting period because the business has already sold the goods or provided the business for this accounting period. An income receivable is money owed to the business and should be treated as a current asset. Since it is expected to be collected soon. Now let us illustrate with an example. So let's take a look at example 3. A trader earns a commission of $100 per month. Up to 31st December 2013, the end of the accounting period, only a total of $900 was received. Now examine the question and ask yourself, there are 12 months in a year, so what should the commission income be for the whole year? It should be $1,200. However, the business only received $900, which is only 9 months of commission income, which is from January to September. Now, the trader has already provided the service up to 31st December. So he should recognize and record the rental income from October to December as well, even though he has not received the cash yet. So let's take a look at how we record in the general journal. We start with the journal entry for recording the receipt of the $900, which is the commission income received from January to September 2013. So what we do, we will debit cash at bank. And credit commission income. For $900. Now on 31st December 2013, we notice that there are still 3 months of commission income that have not been received yet, but has already been earned. So we have to record this as commission receivable, as the business expects to receive this income in the following year 2014. So we debit commission receivable. And credit commission income. Now note that commission receivable is a current asset account. So a debit is plus, credit is minus. So when we debit commission receivable for $300 and credit commission income for $300, we are actually increasing both the commission income and the commission receivable by $300. Now, since commission income is an income account, the amount has to be transferred to profit and loss so that it will appear in the income statement under other income. So how do we know whether we should credit or debit profit and loss? Now, note that the commission income is an income account, so debit is minus, credit will be plus. From the journal entries recorded previously, you should see that there is a credit balance of 1,200. 900 plus 300 in the commission income account. So in order to transfer this amount to profit and loss and reduce the balance to zero, we have to debit commission income for 1,200 and credit profit and loss for the same amount of 1,200. We will next look at the ledger accounts for a better understanding. Recall that our first journal entry was debit cash at bank and credit commission income for $900. So we will write $900 in the credit column because we credit this amount. So credit $900. The account that we debit is cash at bank, so we write it here. Remember to write in 900 credit in the balance column. The next journal entry is debit commission receivable and credit commission income for $300. So we will write 300 in the credit column also and write commission receivable, which is the account that we debit. The balance now has increased by 300 credit, so the balance is now 1,200 credit. Lastly, to transfer the amount to profit and loss in the income statement, we note that there is a 1,200 credit balance, so we will need to debit commission income by 1,200. The account that we credit is profit and loss, so we write this here. Note that after this, the balance is zero in this account. For the commission receivable account, recall that on the last day of the accounting period, 31st December 2013, we debit commission receivable and credit commission income by 300. So we record 300 in the debit column and write commission income here. Which is the account that we credited. Write in the balance of 300 debit in the balance column. After this, remember to bring down the balance to the next accounting period. So we have a balance brought down of 300 debit. Now what happens in the next accounting period? Similar to the accrued and prepaid expenses that you learned earlier, we have to make reversal entries at the beginning of the next accounting period. This is to ensure that the earned income that has not been received in the current accounting period is not included as earned income for the following period. Now, how do we do this? Firstly, take a look at the balance of the receivable account, which is this. This is the amount that we want to reduce to 0. So we will credit the receivable account and debit the income account by that amount, which is 300. We will illustrate with an example. Now for our example on commission receivable, we note that there is a debit balance of 300 in the commission receivable account as of 31st December 2013. So our journal entry will be to credit commission receivable by 300 and debit commission income for the same amount. So we commission income 300 and we credit commission receivable also by 300. Take note that the date of this journal entry must be the beginning of the next financial year. So for this example, it is 1st of January 2014. Now this date may be different depending on the date of the end of the financial year for the business. We'll take a look at what is the effect of the accounts by recording this journal entry. Take a look at the commission income account. Now this part here is what we have recorded in the year 2013. So in the beginning of the year 2014, when we recorded this journal entry, we debit commission income by 300 and we credit commission receivable by 300. So we have to write 300 in the debit column here and we write commission receivable here. So there is a balance of 300 debit in this account after that. Note that a debit in an income account is a minus, meaning there is a negative 300 in the income account. Now when there is a receipt of money for the commission income, this amount will be deducted from the amount received and will not be calculated in the income for the year. Let's take a look at the commission receivable account. Now this is also what we recorded in 2013 and we have a balance brought down of 300 debit for commission receivable. Now when you pass this journal entry, we actually credit commission receivable by 300. So we have to credit commission receivable by 300. What was the account that you debited? It is commission income. So you write commission income here. So you notice that the balance of this asset account, commission receivable, will be cleared to 0 after the reversal entry. Now, what is the effect of making these adjustment entries for income receivables on the financial statements? Let's look at the income statement first. So under other income, we have this commission income. Now what will the amount be? 900 is the amount that you receive in cash. 300 is the amount that you recorded but has not received, but it should be considered earned for the year 2013. So the total commission income for the year 2013 is not 900, but instead it will be 1,200. Now the adjusted trial balance, the unadjusted trial balance, will actually show the actual amount that was paid, which is actually $900 during the year, which is not correct because $300 was actually earned for that year. So you should add your $300 to 900 to adjust the amount to 1,200 for the year. Now how about the balance sheet for the year? You, under your current assets, you have this account called commission receivable. What will the amount be? The amount will be $300. Because this is a current asset. Now, having seen how the adjustments affect the financial statements, can you tell what are the effects of not adjusting for income receivable? Now, looking at the example above, what will happen if the commission income of $300 was not adjusted or recorded? Now, commission income, because you never record, will now be understated by 300 because you did not record the income earned for the 3 months of October to December. Now, because of this understatement of commission income, your total income will also be understated by 300. So, as the total income is now understated by $300, your profit will be understated by $300 as a result. How about the effects on the balance sheet? Now, if you had not recorded this commission receivable, there will not be any commission receivable in the current assets part of the balance sheet. So if there is no commission receivable, your current asset will be understated by 300. Because the profit is now understated by 300, your equity will be understated by 300. The next segment of the video will show you the accounting treatment for income that was received in advance, which is also what we know as unearned income.